Hello everyone, when you are going to RBI website and you want to read, you want to study something very useful, summarized about what RBI is doing is the speeches. Speeches mostly done by governor and deputy governor, sometimes by executive directors also. Here I found one very interesting one, journey towards inclusive and responsible microfinance sector. But by this example I am going to tell you how to read speeches from the RBI website. Though still I will tell you all the summary point keep coming in the newspaper, financial newspaper especially, but you want to go sometime into the detail. This is slightly longer video only for the serious aspirant. My name is CP Joshi. I have worked with RBI. I was a grade B officer when I joined. Later I got promoted at AGM. At Exam B, we help your preparation making 50% faster. This speech is given by Mr. Rajeshwar Rao, Deputy Governor. He actually also from the Grade B channel. I am reading the text but highlighting the important point. Ladies and gentlemen, at the outset I would like to thank MFIN. Now the point is, what is MFIN? So, this Microfinance Institution Network and Association of the Microfinance Sector in India. The name microfinance means small finance. What is that? Lending to self-help group, joint liability group. He mentions also in the earlier speech in October last year, I highlighted some of the aspects typical to the borrowers and lenders in the microfinance sector. These related to, what are those aspects? Please understand these important aspects for the sector is indebtedness of the borrower, pricing of microfinance loan beside conduct related issues. So these are the important things, over indebtedness and pricing. Then he says, I also stress that the emerging dynamics in the microfinance sector as well as the concern around customer protection necessitated a review of the regulations so that all the regulated entities engaged in the microfinance pursuant to the goal of customer protection within a well-calibrated and harmonized setup. To address these concerns, RBI in March 2022 came out with a revised regulatory framework of the microfinance sector. That is what is discussed here. Why it is important? He says, considering the large customer base of the microfinance, that is 6 crore borrower, you have to know this number. This way microfinance can make a more meaningful contribution to the economic development because this money is going to the low income households to help them come out of the poverty, helps women to become owners of the asset. Microfinance borrower more than 95% are women. That also increases their say in the decision making. See, this is the empowerment of the woman through finance. Lead dignified lives embodying the concept of collective good. Because here the lending is done based on the social collateral. It's a group lending methodology. Microfinance plays a critical role in promoting inclusive growth by way of making credit available at the last mile and therefore acts as a safety net for those at the bottom of the pyramid. There is a famous book written by CK Prahlad, Fortune at the Bottom of the Pyramid. So here actually microfinance has become a good business, though helping to the poor people. I believe, he says, I believe that the holistic impact of the microfinance goes much beyond the impact created by any other credit facility. If I highlight here, in field of the finance, there is one Nobel Prize which has been given to a banker. Can you write the name in the comment? That will help you in understanding the impact of this microfinance sector. Borrowers often utilize the loan for health and education apart from income generating activities. So it helps them deal with everyday emergencies that they encounter. So this is helping in financial inclusion, collective good, inclusive growth and emergency funding for these people. Now come to some important data. The story of microfinance in India is a story of growth and inclusiveness. Total microfinance portfolio today is 2.3 lakh crore. It's not that big an amount for 6 crore borrowers, in which bank hold, who are the largest shareholders here? Banks, followed by NBFC, MFI are microfinance institution. It's a category of NBFC, 35% there and 38 are bank, followed by small finance bank and other NBFCs. If you include SHG bank linkage, so SHG bank linkage is a separate program. It is also group lending. In this, banks are lending to SHG. SHGs also have a saving account. I have told that in several videos. If you include that also, then the total portfolio becomes 4.82 crore. So 2.93 only microfinance JLG based lending, and including bank SHG linkage program, it is 4.8 lakh crore. The order is this important to understand for the exam. Now coming to this microfinance operations state-wise, if you see, it is spread all 28 states, 9 union territories. But here you notice that there is major regional distribution. Major portfolio is in eastern and actually in northeast. The major is again in Assam, large contributor, which is 37% of the total portfolio, followed by southern region. 10 years back, if I tell you, South used to contribute more, especially 4 states, Andhra Pradesh, Tamil Nadu, Kerala and Karnataka. But now the eastern contribution is more. Bandhan Bank is a major contributor here, right? Then the portfolio from West Bengal, Odisha and Assam. And West is 15%. And if you see from that side, because eastern part of the India, there are large number of people. If you include state of West Bengal, Bihar, Odisha, microfinance continues to be important. 82% of the portfolio now is concentrated in 10 states. It is not well spread that way, but it is in all the states. Now coming to the regulatory timeline for microfinance sector, 30 years ago in 1992, innovative model. NABARD started this self-help group bank linkage program in 1992, 30 years back. A slew of policy measures and approaches have been put in place to bring the financially excluded population with the ambit of formal financial institution. These kind of stories, this kind of historical background help you in writing the descriptive answer. That's why I am discussing it here. While microfinance journey started with SHG bank linkage, SBLP program, microfinance institutions subsequently also adopted JLG mechanism. So I told you, if you see the portfolio we discussed just in this speech, 2.93 crore is in microfinance, which is basically JLG model. But SHG bank linkage, if you include, that becomes 4.82 lakh crore. Only SHG bank linkage program is 67 lakh SHGs, having an outstanding portfolio about 1.5 lakh crore, leading to a social, economic and financial empowerment of the poor and especially women. About the regulation, December 2011, RBI came out with framework for regulating NBFC MFI with the eligibility criteria for microfinance loan linked to the core feature of the microfinance were prescribed. What was that? A small collateral free loan to borrowers belonging to low income group. Collateral free means there is no security. You cannot keep the house or any property or any asset as a collateral in these loans. The group guarantee is the only security and given to the low income group. I will come to that. What is low income group? What is the definition? The regulations laid special emphasis on the protection of the borrower and adoption of the fair practices of transparency in charges, ceiling on margins and interest rate, no prepayment penalty, flexible repayment schedule, non-coercive method of recovery and measures to contain multiple lending and over-indebtedness. That was taken care in the December 2011 regulation. Not that you need to remember every point, but understand the spirit of the regulation that time, because we are talking on behalf of RBI here and you are looking for a job, say in RBI and NABARD. These are very, very important points. Introduction of the comprehensive regulatory framework for NBFC MFI with a mandate of providing credit to low income household meant fundamental structure for provision of the credit to the excluded section was in place. But this addressed only part of the problem. What is that? On one hand, we had commercial bank which were providing saving product to the poor. Saving account were there, but they were a bit wary in providing small ticket loan. Wary, a new word for you, worried. Okay, they were worried in giving a small ticket loan without any collateral. On the other hand, you see the problem. NBFC MFI, they were providing loan, but they could not provide the saving related product. They are not allowed to take savings. No, they are not banks. NBFCs are not banks. A very, very smart move by RBI here is introducing differentiated bank. That happened during the period of Raghuram Rajan. More committee recommendation, Nachiket More committee, who was also in the board of RBI, that recommended differentiated banks. So small finance banks were created. So the problem, NBFC only doing lending and banks were doing saving account for these poor people. Now these small finance bank were introduced who could offer deposit facility as well as they were doing small ticket loan, because for them it is a mandate also. Therefore these small finance bank could meet the entire financial need of the low income household under one umbrella. Interesting why small finance banks have been introduced by RBI over last decade. So 2011 regulation, right? After that last decade, landscape of the microfinance sector has undergone significant changes from being an MFI dominated proposition to becoming a bastion of banks, including a small finance banks. So earlier it was microfinance means MFIs were doing it, NBFCs were doing it. Now banks have significant stake here. We saw the percentage also. This has been primarily driven by conversion of some of the large MFI to the banks, small finance bank, like Bandhan was converted into a full-fledged bank, then Ujjivan, Janlakshmi, Utkarsh, many of these have been converted into a small finance bank, consolidating the microfinance sector. Consequently, the share of the standalone MFI, that is MFI NBFCs, in the overall microfinance sector loan portfolio has come down significantly. Percentage-wise it has come down, right? The portfolio actually increased. This has led to a situation where specific customer protection measures designed to protect the interest of the vulnerable microfinance borrowers were not being adopted by a large number of lenders, thus negating the primary objective of the regulation, because regulation was more going towards the NBFC MFIs. So here RBI comes out with a comprehensive and revised regulatory framework for microfinance loan in March 2022. And the basic framework here is customer protection. 5 core principles. First, addressing regulatory arbitrage with the introduction of the lender agnostic and activity based regulation. Not one for bank, another for NBFC MFI, rather lender agnostic. Protection of microfinance borrowers from over indebtedness. This had been one of the problems in some of the areas. More and more loans were given to people beyond their repayment capacity. And then coercive recovery measures, enabling the competitive forces to bring down the interest rate. So that is the idea, by way of more transparent measures. Enhancement of customer protection measures by way of strengthening them and extending them to all regulated entities. Facilitating flexibility to design product service to meet the need of the microfinance borrower in a comprehensive manner. So these are the basic principles. Here again, you need to remember everything, just understand what is this. So when we talk about the income criteria, because when we said that it has to be for the poor people, earlier the criteria was something for rural 1.2 lakh rupees per annum of the income for rural and 2 lakh for the urban. So this time now when RBI changes, it made the limit to 3 lakh rupees, because in urban areas also there are poor people. We know in every city there are slums, so why they shall not be given this microfinance loan? The new framework also envisages a situation wherein a household who is lower band of the household income limit is provided loan consistent with their repayment capacity. The emphasis now is on the repayment capacity of the borrower rather than considering only indebtedness per se or indebtedness from NBFC MFI in isolation. So indebtedness from the bank also to be counted. Maximum loan has been linked to the household income. There have been some demands for further increasing the household income limit, while for now it seems adequate given the profile and the need of the microfinance borrower. One needs to be cognizant of the fact that other channels are always available for entities intending to provide higher loan amount. Now comes important issue of pricing and transparency. Under the new framework, rule-based guideline on pricing of the loan have been replaced with a principle-based framework based on enhanced disclosures and transparency requirement. One major change in this introduction of the simplified fact sheet, which spells out the methodology for calculation of all inclusive effective interest rate. So if I just try to explain to you, so in addition to the interest rate, there are processing charges, there are insurance charges. So different kind of charges have been levied. So here RBI is saying it needs to be understood that the effective interest rate in the fact sheet reflects all inclusive cost of the loan to the borrower and not the internal rate of return to the lender, the lending institution, a bank or MFI. There was some demand to not to include insurance cost in this, but RBI Deputy Governor is saying that insurance is ultimately the cost is borne by the borrower, and the idea here is this is the insurance for the death of the borrower. Suppose the borrower dies, then the loan is insured, so it's like a credit risk premium. So it says the logic he is explaining here is that is the cost which the borrower is bearing here. So that shall be mentioned there, because by this insurance the risk of the lender is reducing. So risk premium is being paid by the borrower. Suppose there is no such insurance, in that case the interest rate may be little higher, because that becomes more risky position for the lender here. At a borrower level, it needs to be understood that the intent of the regulation is to make borrower aware of the total cost being paid by him for the loan, and at the same time comparability among the lenders by standardizing calculation of all inclusive cost. It is expected that availability of the such information will help the borrower in making informed choice while assessing the availability options. In addition, the specific pricing related regulation, this framework needs to be seen in holistic manner, wherein certain indirect but equally important measures have been introduced to bring down the interest rate. Also, it is saying that the cap on the repayment obligation is expected to nudge the lenders to keep the interest rate low, so that the repayment installment do not exceed the maximum prescribed limit for repayment obligation. Secondly, the measures to check over indebtedness should also result in the improvement in the credit worthiness of the borrowers, bringing down the credit risk premium, which should translate into lower interest rate. Thirdly, enhanced awareness among borrowers through simplified fact sheet and no prepayment penalty on microfinance loan would enable them to easily switch between the lenders. See the way it has been nicely written. 1, 2, 3. You can learn also the writing style, going to help you in descriptive answers, how to write. Fourth, a reduction in the minimum threshold of microfinance loan to NBFC MFI from 85% of the net assets to 75% of the total asset is expected to lower their concentration risk and cost of funds. And fifth and finally, an increase in the maximum threshold on microfinance loan to other NBFCs from 10% to 15% of the total assets should increase competition. If you feel you are not able to understand all these points, that is absolutely fine. But if you want to understand, you can ask in the comment. I will try to reply as much as possible. Addressing regulatory arbitrage. What is regulatory arbitrage? So two types of institution. There is different regulations in case of say bank and NBFC MFI. So in 2011, microfinance sector was evolving. There was a need to introduce rule-based regulatory framework to bring some order in the sector. But over a last decade, the sector has come long way. The prudent practice in the microfinance sector as well as laid out are better understood now. Therefore, product-specific requirement for microfinance loans such as absolute limit on loan amount, number of lenders, minimum tenure of the loan, etc., which were anyway applicable to only NBFC MFI, have been withdrawn. Now, the new framework provides the flexibility to lenders to customize their product and services to better meet the needs of the microfinance borrower. I am skipping this point of business correspondent, but I am just summarizing that many of the institutions were becoming business correspondent of the bank, so the portfolio they were managing were not reflecting in their book because the accounts have been managed in the lending institution. So all such kind of factors have been taken into consideration in the new guidelines, 2022 guidelines. Important point is responsibilities of the board and overall conduct. So these are the broader aspect again. The board has to be responsible in the new framework, laying down the fundamental principle places greater onus on the board of the regulated entities, as they now also require to have a board approved policy in certain areas such as assessment of the household income and indebtedness, pricing of the loan and conduct of the employee. So all such policies has to be board approved, whether in case of the bank or NBFC, the small finance bank. The framework in a particular emphasis on having a system for recruitment, training, monitoring of the employee. Training modules for employee and outsourced personnel should include program to include appropriate behavior towards customer. Their conduct towards customer should also be incorporated appropriately in the compensation matrix, because there has been a lot of complaint on coercive measures used for recovery. The guideline related to the adherence of the fair practice in recovery of the loan and outsourcing of the activities has also been reiterated. One important aspect of these guidelines is that outsourcing of any activity by the regulated entity does not diminish its obligation, and it shall be accountable for inappropriate behavior by its employee or employee of the outsourced agency. Suppose a bank has appointed a business correspondent who is doing the recovery of the loan, the bank becomes responsible here, shall provide timely grievance redressal or both. Given the responsibilities entrusted on the board, the directors on the board of the lender should take active interest in the policies governing the microfinance loan in order to ensure that these policies result in the fair treatment of the microfinance borrowers. Expectation from the industry. These are again broader point. The revised regulatory framework provides significant flexibility to the lenders to fulfill the need of their microfinance customer in a comprehensive and customized manner, with increasing competition and level playing field for the regulated entities in the sector. One of the differentiating factors going forward will be the customer's experience with the lender services. So it tells about conduct towards customer being integral, ethical and business practices. It becomes the responsibility of the everyone involved to ensure that the guidelines on conduct are followed in letter and spirit, not just for the sake of showing it to RBI, but it shall be followed in letter and spirit. To ensure borrowers' protection from coercive lending recovery practices, the framework also requires putting in place a mechanism for engagement with borrowers facing repayment-related difficulties, prohibition on harsh recovery policies, extensive due diligence process for engagement of recovery agent, and a dedicated mechanism for redressal of recovery-related grievance. While we acknowledge the right of the lender to recover due loans, the Deputy Governor is saying, I would like to make it clear that no uncertain terms that RBI has zero tolerance for misconduct towards the borrower. He is saying that you would agree that exclusive focus on business growth and bottom lines without considering the vulnerabilities. Bottom line means profitability. So top line means revenue. Okay. Considering the vulnerabilities of the borrowers by any entity is fraught with pitfalls. Irresponsible lending by few lenders ends up putting the interest of the entire industry at risk. Therefore, it is the collective responsibility of all the lenders and SRO. SRO are self-regulating organizations. So these MFIN, where he is giving this talk, and Sadhan are two SROs for microfinance sector, to keep a check on the sharp and aggressive practices in the sector. There are sufficient avenues for the microfinance sector to grow business, as availability of the credit is at the last mile still remains an unfinished agenda. At this level, credit is not easily available. The industry shall work toward increasing the size of the pie while balancing the interest of the vulnerable borrower. He is also saying that I am happy to note that a revamped code of conduct was recently launched on 4th October 2022. The code of conduct is an industry-led initiative with primary focus being to promote and advance responsible lending practices for protection of the customers. The 7 elements in this code are fair interaction, suitability, education and transparency, information and privacy, grievance redressal, employee engagement and customer communication. Essentially capture the range of the issues which the revised framework also encapsulated. However, as for any voluntary regulation to work as intended, it is incumbent upon all the players to adhere to the code both in letter and spirit. He repeated here. Going forward, there is a strong case for adoption of technology. Important case here. Microfinance sector do not only improve efficiencies and bring down the operational cost, but also mitigate operational risk such as fraud, enhance service experience and create customer awareness. Leveraging the digital solution can enable the microfinance lender to increase their productivity manifold across the entire lending cycle. Concluding remarks, Deputy Governor says MFIN has been instrumental in multiple initiatives to strengthen the sector during the decade to develop the microfinance ecosystem. The current MFIN Microfinance Review Report provides data-supported insight and has been enriched with MFIN experience. The report discusses in detail the organic evolution of the microfinance sector and supporting ecosystem lending up to the new regulations. He is saying it has been our constant endeavor to support microfinance sector. So RBI is giving regulation, but at the same time see the spirit of RBI. So they support also creating a new sector, a new industry here, addressing regulatory gap and arbitrage arising from differential regulation across the spectrum of the entities. Towards this objective, we have introduced structural changes by revamping the regulatory framework for microfinance loan in 2022 March. We would like to see through its successful implementation on ground before taking further step. He is repeating that customer protection, the focus C, customer protection at the core of microfinance regulation, and it has been our guiding light while revamping the regulatory regime for the microfinance sector. He is saying we have moved from a rule-based approach to principle-based approach. Again, keyword, rule-based. So earlier RBI was telling how many lending institutions, some detailed guideline on the margin pricing. So now it is principle-based regulation, thus creating enabling environment for more financial institutions to serve the excluded while protecting their interests through competition and transparency. I am hopeful that these regulatory reforms will provide the requisite impetus for the long but immensely fulfilling journey towards the inclusive and responsible sector. This is the speech. Now I am reading the comment of one of the paid user for RBI 2022. Exam course played a significant role in my pursuit to become an officer in Reserve Bank of India. Straight off the bat, I found free past year mock test QRE GA to support useful, and phase 2 material also seemed concise. I fondly recall Sushil Ragare sir, I think all of you know him, kind enough to carve out time for 101 session with me a week before my interview. His sage advice gave me a clear sense of direction on how to take potential interview questions. Thank you, Exam B. There are many such comments. You must be watching these videos by successful candidate. We are constantly uploading on this channel. Sushil Ragare has been instrumental in selection of thousands of aspirants, sending them to regulatory bodies like RBI, CB, NABARD. He is doing it for more than a decade. And here you have access to distinguished faculty like Dr. Sharma, ex-Chief General Manager of RBI, Mr. Chakshu Mirakor, who cracked RBI Grade B in 2017, and Exam B is sincerely helping students in making their career in unfolding your potential. Feel free to reach to us at 920-552-4028. We help you making your preparation 50% faster.